to Be, and I'm here with Mark Wagman, the Managing Director for Aquis Trade Credit LLC. Today we're going to go over the sluggish economy and what's next for credit markets.
Okay.
So for today's agenda, what we're going to do is we're going to start off providing an overview of the existing economic conditions, followed by discussing the impact on credit markets, reviewing the implications for corporate credit quality and risk mitigation, and providing a forum for open discussion as well as questions and answers. So the first thing we're going to do is just do a little bit of a background introduction on Credit to Be, who is the host of today's webinar. Our mission is to provide timely, relevant, and highly accessible business credit information. We do this through combining trusted credit networks, credit bureau information, and expert credit analysis, which all comes together to equal relevant, actionable information powered by community IQ. So how Credit to Be helps, we take a bunch of different areas and bring them all together. And Mark, you could just hit the slide a couple more times.
Okay.
And this all comes together into sort of a one-stop shop for all of your credit solutions. Then just to introduce Mark, he is the principal at Aquis Trade Credit. He's an expert advisory on brokerage of credit and political risk mitigation products. He has over 25 years of experience in commercial finance, investment banking, and credit protection. Represents Fortune 1000 and mid-market companies across a wide range of industries. And the key service differentiator is that Aquis uses capital markets to find solutions which traditional credit insurance markets won't support. And with that, I'm going to turn it over to Mark to start the presentation.
Thanks so much, Justin, and good afternoon to everybody. And again, I'd like to extend my appreciation to Credit to Be for making this time available to us all and give me an opportunity to share my views on what's going on in today's world in terms of the economy and credit. So first, just looking at this at a high level, I'd say that the U.S. economy is hardly robust. There's definitely a mixed set of signals. The most key of which I would say are generally negative, but there's definitely a positive light on the horizon, particularly when you view it in the context of the rest of the globe being, for the most part, in an economic rut, with really few exceptions. And I think that at least from an American perspective, the only way that we're really going to get out of this is with a pretty radical transformation in public policy and how we address these issues, really starting, I think, in government. With all of that, I think we'd also say that there are certain sectors with a brighter outlook, but we could talk about that towards the end of this discussion. So I'd first point out by stating that in spite of whatever issues that we've seen in terms of sluggishness, the outlook for corporate profits is pretty good, especially if you look at it since the end of the financial crisis. Corporate profits have surged. I think early on, immediately post-crisis in 2008 and 2009, I think a lot of people would agree that the surge in profits corporately that we saw was due to what's called the wringing out of operational inefficiencies. The question is whether or not that's actually sustainable, and I think we're going to talk a little bit about that sustainability issue shortly. But suffice it to say that over the long run, corporate profit growth has to be driven by fundamental soundness in a company's business model and the opportunity for true revenue growth, as opposed to wringing out, cost inefficiencies. And views from the perspective.
Mark, we're actually going to go back and do a polling question on this topic. So everyone, I'm going to launch a polling question, and that question is, how do you feel the rate of corporate profit growth is sustainable? So if you guys could just pick one of the answers to that, and then we'll give you a few seconds to put it up, and we'll take a look at the results. So something else I want to mention to everyone while we're polling is that on your sidebar you'll see a section for questions and chat. If you have any questions or anything that you want brought up during the presentation, feel free to post those questions there, and we will post them to Mark and have them answer them while we are going through the presentation. So I'm going to give it about 10 more seconds. We've got about 80% in right now, so if anyone else wants to vote, feel free. All right. So I'm going to close the poll right now,
Okay.
and then just share it. So, Mark, if you want to take a look at these and then sort of comment on what you think will happen and if this growth is sustainable.
Do you want to read that off to me, Justin, only because I'm controlling the screen and I have to exit out of here?
Sure. Right now we have that 9% say this is a sustainable rate. 43% say it is not sustainable. Profits will continue to grow, but the rate will diminish. 13% say that the corporate profit growth rate will stagnate, and 35% are not sure, and they need to see what's going to happen in the next 6 to 12 months.
Fair enough. But just to be clear, since I don't see it in front of me, 48% believe that it is sustainable, correct?
9% believe it's sustainable. 43% say the profits will continue to grow, but the rate of growth will diminish.
Okay. I'm with the perpetual optimist. I believe that they'll continue to improve as well. However, I'm of the mindset that there has to be, let's call it a change in mindset, and that is that we've got to get our leadership outside this box of this new normal, being that, for example, GDP growth and corporate profit growth it has got to be sluggish. What I would say is that it's very much a sustainable thing if there's a smart undertaking in Washington and at a state and municipal level for pro-growth public policy. It's unfathomable to me that in a country as successful and technologically innovative and wealthy as ours, that we have the highest or the second highest corporate tax rate in the industrialized world. Think of the tens of billions, possibly the hundreds of billions of dollars in investment that could be freed up with more favorable corporate tax rates and a much less onerous regulatory environment. And I would add further that the rate of the interest rate environment is likely to increase. I think we're looking at a period of higher interest rates later this decade. And I would say that even were that to occur, I still think it's sustainable if there's a new change, a mindset in Washington and at a state and municipal level.
Okay. So you can feel free, I just hid the results, feel free to go on to the next slide.
All right, thank you. So again, looking at some of these more sluggish numbers, capital investment. This is non-residential fixed investment. You can see how well this tracks really closely with the economic cycle. Going all the way, we tracked the data back to the early 70s, and you can see that really every downturn in capital investment measured as a percentage change year over year has corresponded very well with every major downturn that we've seen in the post-war era in 1976, the early two actually recessions in the early 1980s, then again a mild one in the early 1990s, again one in the early 2000s. Of course, the one that is most severe, that being the Great Recession in 2008, 2009, and you can see that in every instance where we had a recession prior to this one, the rate of growth, for the most part, was considerably higher coming out of that trough than was the case in this most recent recession. And that's a phenomenon that we're going to see time and again. That's going to be a recurring theme in some of the slides that we see going forward. For example, this one, where we're talking about the change, the year-over-year change in absolute numbers of non-farm or private sector payroll. it's really a pretty dire picture. And if there's one slide that I would have all of you walk away with in terms of really remembering this discussion that we're having this afternoon, it's this one. And again, you can see all of these troughs corresponding very closely to the economic cycle. Again, the early 80s, the recession in 1991, the really mild recession in 2001, early 2002, and of course the Great Recession. But look at how staggering the number of job losses were between 2008, 2009, and 2010. 7.7 million private sector jobs lost. We are still not out of that. Through the numbers that were just released by the Bureau of Labor Statistics for the month of March of 2014, we've only recovered about 6.5 or 6.6 million of those 7.7 million private sector jobs. So at the rate that we're going, we could still be into early next year or perhaps late this year if we're going to be optimistic at a rate of 150,000 non-farm payroll jobs growing every month, at least for the next, let's say, 5 to 10 months. It's going to be late this year or early next before we finally get out of this very, very deep and troubling trough. And I don't even post here any statistics with regard to the unemployment rate because, as some of you may have followed or may already be well aware, the unemployment rate as it's quoted now, I think at 6.5 or 6.7%, is actually a very misleading number because it doesn't take into account labor force participation. And what that really means is you've got a lot of perhaps very qualified people, or some maybe that aren't, that have just given up on looking for jobs. So the real telltale sign of economic growth in this country is not going to be the size of the growth of government. It's going to be the size of the growth of private sector job growth. That's the engine of an economic vitality and growth. Just again underscoring the same point of this idea that we're coming out of this trough of this very deep recent recession at a slower rate than in any recession past, really measured by any indicator, whether it's private sector job growth or capital investment. Similarly, U.S. GDP on a percentage change year-over-year basis tells the same story. In the last generation or two, the most severe recession that we had was in the early 1980s. And you can see that's a really good contrast. In those first couple of years, right after we came out of that very deep recession, you can see how fast the rate of growth was in the U.S. economy. And that's what we have to be striving for. We can do it, but again, only with smart changes in public policy.
Hey, Mark, we have a question that got posed to you here.
Okay.
The question is, how does the quality of jobs created compare to the quality of jobs lost? He says what he means is, from what I'm reading, most of the jobs created are for much lower in salary.
And I think that for the most part is sadly a true statement. Now, having said that, the one thing that I would not be misled by is the fact that the quote-unquote good or high-paying jobs are coming out of the service sector. There's been, I think, for the last, let's say, 2 or 3 generations, this concern that we've declined as a manufacturing powerhouse. And, I think there are arguments that could be made for and against that. Maybe that's true in heavy industries, but in high tech, we're still pretty dominant. But the point is, 100 years ago, people lamented the fact that the United States was kind of losing its historical sort of roots in becoming, we started as an agricultural country, a country made up of farmers. And when the Industrial Revolution came in the late 19th century, we became a manufacturing powerhouse. And a lot of people lamented the fact that was occurring. But if you look what happened over the course of the 20th century, whereby each generation had a higher standard of living, that could be directly attributable to the growth of manufacturing. Well, here we are now in the 21st century. Manufacturing, to a large degree, has been on the decline in this country, yet our standard of living is still considerably better than it was 20 or 40 years ago. And that's been largely built on the back of a service economy. So I would argue that while it's true that whoever posed the question is, I think it's definitely fair to say that at least since the crisis, since this most recent financial crisis, the quality of the job growth has been poor. I wouldn't lament the fact that we've become more of a service-oriented economy. Okay? Does that answer the question, Justin?
Yep, definitely.
Okay. So now let's talk about the money supply and the concerns that everybody has, I think, justifiably over what the Federal Reserve has done since the financial crisis and what that could mean for creditors and debtors alike. The reality is that the money supply has really been growing off the charts. This year is, by the way, the 100th anniversary of the creation of the Federal Reserve. There's been a lot of hoopla about it in Washington, and the reality is that if you look at what the Federal Reserve has done as a central bank since its founding in 1914 through, let's say, this period in 2007, 2008, if you actually looked at the data that goes all the way back 100 years ago, the rate of change in that almost 100-year period was really pretty flat in terms of money supply growth. But then you have in the last 4 or 5 years this hockey stick effect where the growth has just been off the charts. So what does it really mean? There's a lot of very smart economists who would argue that there's really no threat of inflation here. Look at what has happened over the last 4 or 5 years. Disposable personal income has not changed. If anything, there's been a widening or a disparity in incomes, and there certainly hasn't been an inflationary impact. I think it's hard to argue otherwise. I think the real question is what happens 5 years from now, 10 years from now. Inflation is like cancer. It's insidious, and it often sneaks up on you. Even as sophisticated as economists are today, with all the information that they have at a mouse click, it's still insidious. So I think the bigger concern here than the growth in the money supply is the growth in the size of the Federal Reserve's balance sheet. Every month, they've been buying, I think the number is, it's really a crazy number, something like $80 billion worth of U.S. government securities of one type or another. And the question then becomes, what happens over the course of the next 5 to 10 years as the Federal Reserve has to sell those fixed income assets, those bonds, those obligations? There could obviously be tremendous upward pressure on interest rates. And that bears very close watching for any providers of credit. And just to underscore further the idea that at least for now, inflation remains tame. This is the producer price index measured as a percent of quarterly changes. A lot of economists like to use PPI rather than CPI or the consumer price index because they feel that looking at this from the perspective of wholesale prices is much more telling, especially for the B2B economy than CPI. And I would also underscore, I was at a meeting not long ago where we were, 2 weeks ago, where we were addressed by the head or the number 2 guy at the Fed in Chicago, who underscored that from the Federal Reserve's perspective, they're at least as concerned about deflation as they are inflation. And you can see, for example, just to give you a contrast here, in 2008, in the second quarter, you can see how deeply deflated prices were. So from the Fed's perspective, they're at least as worried about that as they are about big inflation numbers, like we saw, for example, in the early 80s, or even better, in the early 70s. You could see at the top of this graph during the oil crisis.
We have another question coming in, Mark.
Okay.
The question is, didn't private sector jobs have tremendous growth since the new administration took over in 2008?
Hardly. Let's look at the numbers. I don't have the ability to post the raw data, but I've got it on my laptop. But I'll just answer that conceptually. If you look at years during the 1990s and I want to stay apolitical here because what's as true for the 90s under a Democratic administration is as true as a Republican administration, even more so in the 1980s. Private sector job growth during the 80s and 90s on a monthly basis didn't limp along at 125,000 a month, 150,000 a month, 175,000 a month. The numbers every month were 300,000, 350,000, 400,000 jobs, 500,000 jobs in a really spectacular month. That's real private sector job growth. That has not happened under this administration. It hasn't happened in either term. Nobody can argue. I mean, forget what your politics are. Nobody can argue with the facts. Post-recessionary period, there has not been a weaker rate of job growth, either in absolute terms or in relative terms, since the Bureau of Labor Statistics started tracking this information around the Great Depression. So let's talk about all of this in the context of federal borrowing, federal deficits, and how that could impact the private sector. No matter how the Congressional Budget Office calculates it, every 3 to 6 months, there are new numbers that come out from what's supposed to be the nonpartisan Congressional Budget Office, which tracks essentially accounting for the federal budget. And based on the most recent numbers, it's, even though it hasn't supposedly improved, and by the way, it's misleading in its own right because it doesn't include Social Security, which, if this was a private sector corporation, people would go to jail for this. But if you exclude the calculation for surplus as accounted for in Social Security, if you just look at the strict federal deficits excluding that number, these are still really staggering numbers looking out over the course of the next decade. Yes, it narrows somewhat over the course of the next few years, but the problem is, and this assumes, by the way, a stagnant interest rate environment, which is probably not a safe assumption. The scary part of this is that whenever you're talking about deficit financing, especially with an entity that can print its own money, every year that the federal government runs in deficit, it has to not only borrow the amount in the aggregate of the prior year's deficit, it also has to borrow the amount in this year's deficit. So that amount continues to grow. And depending on who you talk to, 5 to 10 years from now, fully 20 or 25% of the federal government's budget could be going to pay interest expense. Aside from how scary that just sounds to us as tax-paying citizens in the abstract, the even scarier part about that for all of us is that it could conceivably crowd out private sector borrowing, especially if interest rates rise. So if you look at, this is just a federal budget deficit projection in a vacuum. This doesn't include the massive deficits that are being run by many states and many municipalities, all of whom borrow money publicly in the bond market. What impacts the Federal Reserve, or rather the federal government, negatively from the standpoint of borrowing costs is then going to trickle down at a state level and a municipal level. And at least from a federal perspective, it's pretty scary when you look at this cumulatively. I mean, these are staggering numbers. Over the next 9 years, we're looking at a accumulated or aggregate budget deficit north of $6 trillion. It's really, really crazy numbers. So now let's talk about the impact on credit markets. Spreads are dangerously narrow again. If we look at the difference in borrowing costs aggregated between investment-grade bond issuers and high-yield bond issuers, the latter being defined as those who have S&P or Moody's ratings that are south of either BAA or BBB-, you can see that over the course of, let's say, the last 20 years, there's really been 3 periods of spikes. One was in the early 90s when we had the savings and loan crisis and massive defaults in the pretty new junk bond market, and then again less severely in the early 2000s, but then again most severely during the financial crisis. Well, part of this difference between aggregated borrowing costs and just looking at baskets of bonds between the two categories, yes, they've narrowed it, but the reality is that the difference in borrowing costs is you've got so many investors chasing really too few deals, and it can be very misleading to conclude that this is a good thing. My understanding. Did you have any questions on that?
Yeah, we actually have one question. The question is, why are the narrow spreads so dangerous?
Well, I just think that it can be very misleading to assume that the difference in relative borrowing costs between the two categories is a favorable thing. It's in my view, to a large degree, artificially generated by a hyperactive Federal Reserve that has driven borrowing costs down really artificially, and in the process has distorted realities in the capital markets, whether you're an issuer of bonds, or you borrow money from the bank, or even if you issue equity. It has distorted the cost of capital, and it's easy to be lulled into thinking that an interest rate environment this low that breeds narrowing spreads to this degree is a good thing.
Okay.
So in the same vein, I think it's also not a good idea to be lulled by the low level of credit defaults. Again, this is occurring in an environment where we've had this hyperactive Federal Reserve that has again been driving down interest rates and really not letting the market determine how risk should be priced and how capital should be allocated. In this graph, you're looking at default rates for leverage loans in the last 12 months of a given period, and the two spikes were again in the early 2000s, and then most recently during the financial crisis. So we're approaching a historical low, at least as viewed over the last 15 to 20 years, and that can be very misleading, given the interest rate environment that we're currently in. Similarly, underscoring this, the changes in credit quality remain a kind of a historical average. This is based on changes up or down. It's basically a ratio of the number of upgrades in S&P or Moody's bond issuance relative to downgrades in the same period. So it's pretty close to historical mean right now, basically at 1-to-1. But again, with no big credit events in a low interest rate environment, it's an arguably how can we say it, deceiving number. This is a very interesting graph. And again, these last few slides have been provided to us courtesy of J.P. Morgan. In this graph, the title is, by the time companies perceive default risk, the market has already reacted. Right here, you're looking at an illustration of the correlation of widening borrowing costs for a basket of high-yield bond issuers relative to the risk-free rate, that being the cost at which the U.S. Treasury borrows money for a similar duration or maturity. And I don't know how good the resolution is on this slide, but basically all I want to do is draw your attention to changes in the gray line, which is the high-yield spread. That's again a basket of high-yield securities, and what their borrowing, the difference in their borrowing costs relative to U.S. Treasuries of a similar security of a similar duration, relative to the default rate for high-yield bonds in a similar time frame. And basically what this picture says is that if you look historically, it's not a perfect correlation, but it's really pretty good, is that every time there's been a spike in spreads, not long thereafter often follows a spate of defaults, and it's best illustrated in the early 90s. It happened again in the early 2000s, and most visibly, most recently during the credit crisis. So the idea here is that it's just as you may have heard the expression, trying to time the stock market as an investor is a sucker's bet. It's very much the same thing here if you're a corporate credit manager or a finance executive. Trying to figure out exactly when a key customer is going to default is a sucker's bet, because it's usually the case that the market's already figured it out. And at that point, if you're going to look to do something like protect yourself with some type of credit protection instrument, it's probably going to be too late. Sort of akin to trying to buy coverage when a building is on fire. Let's look a little bit at recovery rates on senior unsecured high-yield debt. I chose this graph because this is the closest proxy that we could find to unsecured creditors like yourself. It's often the case that companies that borrow money in the high-yield bond market are usually borrowing on an unsecured basis, and in the event of default, those liabilities often fall pari passu or equal to trade creditors. So I thought this would be an interesting proxy for you all to see as to what recovery rates look like for debt securities that would probably cascade kind of the same way as your receivables would in a similar capital structure. So you can see that the recovery rates are definitely have fallen below in the last few years their historical mean. I think that's due to a number of factors, but I would say most influential is the fact that secured lenders are perfecting their liens across the board, and liquidation values have just been plain and simple very, very poor. Any comments or questions on this, Justin?
Nope, none that I see, so you can keep going.
Okay. So retail recoveries and retail bankruptcies and recoveries have been very low. I'm not going to go through all of these, but nowhere has this phenomenon I was describing on the prior slide, been more pronounced than in the retail space. Recoveries in retail have just been really, really poor, and I'm sure pulling down that average that I talked about in a pretty significant way. So, what to expect this year and beyond? Again, sounding like a broken record, but with no major public policy changes, I think that in the States we should be expecting slow growth, same way that the Japanese and the Western Europeans have experienced it over the last decade or two, for at least another 2 to 3 years. And again, I would stress it doesn't have to be that way. We shouldn't resign ourselves to this concept of a new normal. I think it's definitely safe to assume that we're going to be looking at later this decade a higher interest rate environment, possibly coupled with higher inflation, discourage consumers, and again, in the absence of a meaningful change in public policy, at least as it relates to taxes and regulation, weaker corporate profit growth relative to other post-recessionary periods. And similarly, I would also say weaker, even probably more importantly, weaker private sector job growth. I think that it's safe to assume that we're increasingly vulnerable to unforeseen external shocks. The one notable exception to that would be thankfully our greater independence on energy. So that's a very, very encouraging sign. But I think the vulnerability that we could be looking at, could come in other, kind of more insidious ways, including the devaluation of dollar due to, this expansive monetary policy that we've seen at the Federal Reserve. And I think that from a consumer's perspective, it's always touted that if inflation materializes, you're looking at a massive transfer of wealth from lenders to borrowers, and that is true, because then if that occurs, you're repaying debts with a unit of currency that is worth less than it was before. But it's a recipe for stagnation and real discontent, just like we saw in the 1970s. So I would conclude that in terms of expectations by saying that there is definitely a strong possibility of another corporate debt crisis mid-decade or later in the decade.
Hey, Mark, we have another polling question that
Oh,
we're going to
sure.
do based on
Okay.
this slide, so I'm going to launch that polling question
Okay.
now. The question is, which of the following factors do you think will have the biggest impact on the economy in 2014 and beyond? The possibilities are the possibility of another corporate debt crisis mid-decade, weaker private sector job growth versus post-recessionary periods, discouraged consumers, or a higher interest rate environment beyond 2016. So if everyone could take a minute and vote here, we'll share those results in just a minute.
Okay.
And I'd also like to tell everyone again that if you do have any questions, feel free to pose those in the questions section on your sidebar, and we will have Mark answer those throughout the rest of the presentation. We're going to take a few more seconds just to let everyone answer. All right. So I'm going to share the results. Mark, we have 10% saying that the possibility of another corporate debt crisis mid-decade will have the biggest impact, 43% saying weaker private sector job growth versus other post-recessionary periods, 14% saying discouraged consumers, and 33% saying a higher interest rate environment beyond 2016.
I would agree with the majority there. I think it's hard to dispute the fact that without stronger private sector job growth, there's no way we can achieve our full potential as an economy and as a society. So I would have to agree with the majority in that respect, as well as the likelihood of a higher interest rate environment later on in the decade. So thank you for that. It's always very, very useful to know what the thought process is. So, so this is some more data that came to us out of J.P. Morgan, again speaking to the idea of at least the possibility of a corporate debt crisis, mid to late decade. You've got this concept of massive refinancings that have gone on across the board, both between leveraged bank borrowers as well as high-yield issuers of bonds. And while everybody's certainly been wise to take advantage of this, extraordinarily low interest rate environment and these inflation-adjusted borrowing costs that are, at an all-time low, probably the lowest they've been in, 50, maybe 60 years. The reality is that in a higher interest rate environment, there could be really hell to pay when a lot of these debts come due. And, what we've been seeing is definitely consistent with what, J.P. Morgan was kind enough to provide to us here in terms of underwriting guidelines. So, for example, leverage ratios for high-yield credits are increasing. It's like lenders and investors are making some of the same mistakes that they made, pre-crisis in terms of lending guidelines. You got a greater increase in terms of covenant flexibility. A lot of covenant light deals have been happening, and a lot of leverage buyouts and recapitalizations done for the purposes of recouping dividends for the benefit of private equity sponsors. And what I think you're going to see is that the capital market bond issuance and secondary loan trading is going to see a broadening use of the proceeds towards more M&A and general corporate purposes. That's good now, but the risks are over the long run. The fact that new Dodd-Frank regulations and Basel and the Basel agreements that relate to how banks are capitalized is going to probably force a lot more companies to borrow money in the high-yield market as opposed to from banks. So that's not good for the banking system, and it's something that we've already seen happen to a large degree in Europe because a lot of banks just aren't lending to corporates, and you've got increasing levels of borrowing in the high-yield markets going on in Europe. So bottom line is you're seeing, this graph illustrates it very well, a very marked increase in leverage lending in high-yield markets. So what are some of the credit risk mitigation alternatives you can look at? Well, in short, the good news is that the marketplace for this type of protection has increased dramatically over the last 20 years. When I first started in this industry in the mid-1990s, at least in the United States, there were maybe half a dozen companies that underwrote credit protection, at least as credit insurers. And there were really no banks involved in the receivable put or capital market space. It was mostly the playing ground of some hedge funds. Now, depending on how you calculate it, there are at least 13 insurance companies underwriting this type of protection, offering all different kinds of hybrid solutions. It used to be the case that insurers would require companies to cover all of their receivables or all of their accounts. It's not the case anymore. I mean, there's a lot more available in what we call the single buyer space. So if you want to just look to cover, those larger risks or risk singular, you can do that. And there's ways to put together hybrids that include both cancelable versus non-cancelable coverage. There's really a lot of solutions. So it's a considerably more flexible underwriting environment than was really ever the case. And that's true both in the credit insurance markets as it is in the capital markets. This table that I provide to you right here is, I'm not going to go through it line item by line item. I thought it would be a useful reference tool. Justin, normally do you provide these slides to the participants if they ask for it?
Yeah, what we'll do is we'll make those slides into a PDF version, and we'll send them out to everyone who is on the webinar tomorrow.
Okay, thanks. So without going through all these different features, line item by line item, the one that I would probably draw your attention to is the fact that it's the one at the bottom where it makes reference to a risk attaching component and a risk retention component. The receivable put contract is not a risk attaching type of instrument, meaning that the default event has to occur during the contract period, as opposed to traditional credit insurance, which is basically structured to allow you to still have coverage post-policy expiration date, even if you don't renew. So if there's any one feature on here that I would draw your attention to that you should really pay, close mind to, it'd be those points. But the rest of the table, I think, is still very useful, and I'd encourage anyone who has any questions about it to just email me privately. Thanks very much for the opportunity to address you. It was certainly a pleasure, and I welcome any questions or comments or thoughts anybody else might have.
All right, so everyone who's here, we want to thank you for taking the time to spend some time with us. Mark, we do have a question that came in here. It says, after witnessing the actions that Japan has taken over the last 26 years and following their direction in a very low interest rate environment, why should we expect any differences in our economic recovery?
Great question. I couldn't agree more. To answer your question, I don't think we should. In fact, I had mentioned before that that I attended a conference a few weeks ago where a senior guy at the Chicago Fed was addressing us. And I actually posed the question to him because they kept talking about this quote-unquote desirable levels of inflation. And the Fed has set a target of this, I believe, at like 2%. My question, which is, by the way, the same thing that I think the Japanese central bank has done under this new concept of Abenomics. Prime Minister Abe being the Prime Minister of Japan, who's been espousing this idea that encouraging inflation is somehow going to foster economic growth. I think it's nonsense. I think it's totally misguided. I don't think that the Federal Reserve's job should be to create money, to create a money supply. Nothing like that is sustainable. Their job should just be sound money growth, and they should not be concerned about employment. That is the job of public policy and the private sector. So if we're going to basically do the same thing that the Japanese are doing now, or vice versa, I wouldn't expect a different outcome. As I said a few times, I think that there's got to be a kind of earth-shaking change in the mindset in terms of what's going to get it done, and I agree, it's not. I agree with the question posed, it's not going to change it.
Okay. Well, if we have no further questions, I think we're going to look to close out the webinar unless we hear from anyone else. I want to thank you guys for taking the time to listen to Mark today. If you have any questions, you can feel free to either contact myself or Mark directly. And as we said, we will be getting the PDF of the slides out to you tomorrow. As you guys exit the webinar, we will have a poll that comes up. It takes about 30 seconds to fill out, but it always helps us to get some feedback on the webinar and any improvements that you guys think that we can make or ideas that you have for upcoming webinars. So with that, I'm not seeing any more questions, so I'd again like to thank you, and hopefully we'll see you at the next webinar.
Thank you all so
thank
much.
you to you, Mark.
Thanks very much, everybody. Thank you, Justin.